Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, we sit down with Ryan Kirlin, head of capital markets at Alpha Architect, to talk about his personal portfolio and investing approach. We talked to Ryan about his exposure to momentum and value stocks, the realities of trend following, why he shuns fixed income, and how some of his goals have changed now that he has a growing family. We also get outside of the portfolio with details around his rationale for buying a vacation property, views on wealth and children, and much more. As always, thank you for listening. Please enjoy this discussion with Alpha Architect's Ryan Kirlin. Just one more thing before we start. Excess Returns has been growing a lot recently, and all of that is a result of the support from our loyal listeners and viewers. We just want to thank everyone who has taken the time to listen to us and for supporting us and allowing us to continue to reach more and more investors. If you have a minute to do it, we would ask one favor of you. If you have benefited from the podcast and could take the time to subscribe on YouTube or your preferred audio platform and to write a review, that would be greatly appreciated. Both are a big part of expanding the podcast and will allow us to continue to get great guests. Thank you so much. We really appreciate it. Hi, Ryan. Thanks for joining us today.
How's it going?
We've had a number of investors on the podcast to talk about their personal portfolio and investing strategy. And I think it was after the conversation that we had with Wes, the founder of Alpha Architect, which is the firm you're at, somebody on Twitter suggested that we sit down with you. So here we are.
Here we are.
Most of the people that we've had on and talked to about their portfolio have been maybe a little older and more established in just their career, their investing, in their amount of investing that they've been doing. You're a little different in that you're on the younger side. And so I thought to start, if you could just maybe frame up where you're at personally with your life, because I think your investment strategy will to some extent reflect some of that. And we were kind of talking before about sort of different stages in investing. So I'll let you just kind of share with the audience where you are at.
Yeah, right. Because that all affects. And so I got married, I guess 2 years ago or so. I now have a 6-month-old kid, have, aging parents. So definitely my financial outlook has greatly changed in the last 2 years, right? Which definitely changes how you think of investing and the kind of the other potentially more important side when you're younger is income and how much capital and wealth can you get together.
Yeah, a kid changes a lot of things for sure, but they're great. But I think the cost is, I don't know, there's some statistic. When you look at the cost of having a kid, it's like when you total it all up, it's like $300,000 or something by the time they're 18.
Yeah. Cash starts to become much more important versus, when I was maybe in my early 20s and stuff, and all you need is, can you pay your rent and do you have enough to go buy a slice of pizza, right? Like that's your minimum bar.
And you don't realize how expensive baby formula is and diapers are. When you add up those two things, it's ridiculous. So, maybe talk to when you think about your long-term goals in investing and what you're saving for, not necessarily, we'll put the baby on the side for a second, because I want to come back to how you think about 529 plans and if you utilize one or plan to, but what are your biggest goals with your personal investment portfolio, would you say?
Yeah, I think, I read somewhere that it's a bad idea to set goals, and I think that's probably right. You just need to focus on the process, and then the results end up taking care of themselves. I rode for a club team in college, right? So not a varsity program. I rode at Fordham University, and when I was there, I just had this belief that I could make the U.S. team, right? And it was really just kind of a joke to just about everybody I knew, not in a mean way, like nobody was out there mocking me, but it was just in a not able to be understood way, right? Like, you rode for a club team, you can't even make a varsity program, and you think you're gonna row for the U.S. team. Like, just it doesn't really make sense, right? But so how did I do it? Well, I just kept at it longer. I got cut from the U.S. team once, and I just kept waking up every day at either 4 or 5 a.m. And then probably the most important, I made those 5 a.m. wake-ups count, right? So I didn't just go through the motion, because that's as bad as not waking up at all. That's, like I would call that vanity work, which you see people do. So like, what are my long-term goals with my investments is I don't have a specific goal there. I would say for how I think, it's important to understand what phase you're in, or so if we're talking about me, because I guess it's kind of weird for me to talk about me, right? Hey, you're never supposed to talk about yourself. But yeah, so I guess if we're talking about what phase am I in, well, it's the amount of capital dictates what phase you're in, not your age, right? So if you have $1,000 to your name, well, investments don't matter at all, right? You got to go find a way to get $10,000, then go find a way to get, $50,000, find a way to get $100,000. Like, that's going to overwhelm any investment decision you make with that $1,000. Is like, go earn more, right? So the only investment decision that matters when you have $1,000 is just not doing something totally idiotic, like buying depreciating asset or losing, like spending it all on clothes and cars or something, right? Because it's like a balance beam. It's like a seesaw, right? The more capital you get, the more important the investment decisions become. And it's not like it's not just this, oh, okay, today investments matters, whereas before they didn't, right? Because while I say that, there is obviously nuance. Like, go back and say, okay, well, if you have $4,000 and you can go find a way to double that via investments, and you turn that into $8,000, well, like, yeah, maybe now you can go buy $100,000 rental property or something, which is now gonna like start you on your rental career. And now you're kind of got leverage in, because that's what rental, or that's what buying real estate kind of does. It brings an element of leverage into play. And now you turn that $4,000 turned to $8,000. You sell that rental property a few years later, and now you got $30,000 in capital. Like, wow, like, so amounts do matter to some extent in the investment decisions you make, but it's a balance beam. And then also kind of what you alluded to at the start, like the stage of your life matters, because when I was 25, I could take some investment risks, like nothing mattered. I could take all the investment risk in the world that I possibly could. And in some ways I did take some large investment risk because I lost my capital. Great. Like, all I need to do is be able to, as I said, can I go buy that dollar pizza down the block? I used to live in New York City for a bit. Like, they have these things called dollar pizza. So I'd get a lot of dollar pizza. Right. Great. Like, so your stage, your life, and the amount of capital you have dictate what stage you're in from an investment standpoint.
I mean, I think you said two very interesting things there that I just want to flesh out. One, that it's the process, and I don't do a good job with this. I'm very much like looking at my portfolio and doing Monte Carlo simulations and looking at what the value might be 30 years from now, and getting all hung up on that. But your point is, just worry about the process, which is probably savings, dollar cost averaging, making sure you're staying disciplined, and on the backside of it, just like with the rowing, on the backside of it, you were successful. But the other thing I'd like to get your thoughts on is that's what makes investing difficult, is that especially as a young person, if you only have $5,000 to your name, or you're early in your career, and you're sort of, it's hard to see the compounding effects or the benefits 15, 20, 30 years down the road. Because to your point, most people's portfolio starts small, but at some point, it grows, and then that compounding becomes a very powerful force. And so I think trying to get more younger investors sort of understanding that is, could be a very valuable thing.
Yeah, I agree. Like, because I did a lot of that too, starting out buying stocks. Like, I started working at the New York Stock Exchange out of college. I think I could say it now. Like, I didn't know what a stock was when I join the New York Stock Exchange. I was an economics major. I took finance classes in college, right? But I didn't like really understand what stocks were. And then so just by doing the act of going and now buying stocks and selling them, and oh my God, I made 10% in a day. And all these textbooks I read in college said that the stock market returns you 10% a year on average, and I just made 10% a day. I am the smartest investor ever. Like, oh my God, I just picked that. Like, you know, and other things. Oh, I watched stocks double that I owned. I bought Facebook at $22 a share because I was like, I don't know what all these people are talking about. Like, this thing's going to the moon. Like, so I bought it at $22. It went to $50, and I was like, I am a genius, right? Like, I know all this, right? And I was $1,000 I put into it or whatever. But that did all snowball in the sense that, yeah, I was able to turn $1,000 into 2,000, 2,000 into 4,000, and that enabled me to eventually buy my first house for a down payment. You know, so like those little things, while I initially said they don't matter, it still does all matter. It's just a great big game of life, and it just changes the severity for how things matter, right? If you lose 100% of your capital when you're 80, I've met people who have done that too. That's a major problem. If you lose 100% of your capital when you're 25, well, you probably didn't lose all that much. And even if it was, you got a lifetime to earn it back.
It's interesting to think about this idea, you know, and you touched on this earlier, this idea of human capital versus investment capital. And like where you are, you know, earlier in your career, your human capital is a much bigger portion of your portfolio. Even though we're going to show your pie chart and human capital is not on there, you know, where you are, that's really important. And where if we have somebody who's 70 years old on, you know, their human capital has gone way down and their investment capital is much more important. And you know, I think that's important to think about sort of as all of us invest our money, that, you know, when you're younger, you know, what you do with your human capital is probably far more important than what you're investing your investment portfolio in.
That's right. Yeah. So, you know, it's a lot of advice when I always give to people starting out, when I say, hey, you know, what should I do with my, or they say, hey, what should I do with my career? How should I think of things? It's the way I thought of myself. You know, I'm not saying I know all the answers, so this take it or leave it, I guess. But I always thought of myself as a growth company, right? So what you're 22 years old. Like what does a growth company do? Well, you're not trying to generate earnings. You're trying to raise your revenues as high as possible, right? So like as a young person, you're trying to figure out how can you make yourself as valuable as possible so that your future income will rise. And so that meant things like, I mean, a quick side story. I was at this ETF company called Revenue Shares. We got acquired by Oppenheimer Funds. When we got acquired by Oppenheimer Funds, they were like, "Hey, Ryan, you're going to give a speech to all of our 350 sales employees like next week." I'm like, "Copy that." I'm at a new company. I want to put a good foot forward. So I, without telling anybody, I took that Friday off. I had to give the speech Monday. I took that Friday off. I paid $3,500. I found a public speech coach in Washington, D.C. I lived in Philadelphia. I just booked her, paid $3,500, which was a lot of money to me. And got on a train, rode from the Amtrak down to D.C., went through 8-hour class with her, like working through the speech, and then went up, gave the speech, and other people also had to give a speech, and they ranked us. And then, you know, I was ranked the number one speech person at Oppenheimer for that, for ETFs. So it was like that, you know, like it paid off, right? But I did not care at all. Like the $3,500, I was like, who cares? Like if I can go be the number one person, well, that's going to pay much bigger dividends down the road. Like let's focus on that. So like, I mean, for me, anytime I could invest in myself to potentially improve my outcomes, like that can include the way you dress, right? I think some people take the act of like, oh, hey, don't worry about how you dress. I want to dress calm. I kind of take the opposite view. I'm like, I'm not good enough to dress like Wes Gray, right? I don't have like Chicago PhD, Marine Corps out the wazoo. So I'm like, you know, let me at least dress reasonable so people know that I'm a reasonable human out the gates. Like I just don't want to put myself in a hole starting out. So yeah, just personal opinion. But yeah, Wes can dress however he wants, right? So
Yeah, that's a great that's a great story because in the wake of 2020, we've seen a lot of people who are maybe younger who are focusing on investing their assets and maybe doing some risky things with their assets, and a lot of those people are probably better off focusing on what they can do in their career and what they can do personally. Like your example of what you did there, that's probably going to produce more dividends than trying to buy the next risky stock.
yeah, and still good. Like I said, still good to think about investments and do it because capital compounds. Like $10,000 40 years from now is going to be worth a lot more than $1,000 40 years from now, right? So it's a game, it's a balance. How do you divide the two perfectly? There is no perfect answer. That's the game.
Before we look at your pie chart that you provided, I want to start by maybe talking about the vehicle, because one of the things we have a lot of investment advisors debate, is this idea of which vehicle you use to sort of save for the long term when you're younger, or at any stage. There's this whole debate of Roths versus traditional, and I'm wondering, how do you think about when you're saving your money that you're investing? What are you using tax deferred approaches or using taxable approaches? How are you thinking about how you save that money and what vehicle you invested in?
I kind of had my eyes, and this is where it's, like I say, it's a game and you're just constantly learning. I kind of had my eyes opened a little bit by the financial advisor friend of mine, Travis Gatzmeyer down in Texas, because he was like, well, no, you kind of should put more of your money into taxable, like ETF wrapper, and versus your IRA 401k. And I guess to take a step back there, if you're getting a match, right, like that's the basic financial recommendation. And if you're getting a match, a 401k match, they're matching 3%, 50% of what you put in, or full match, like you should max that out, right? Because that's free money. And even if you had to pull that out and pay taxes on it, you would still be ahead of where you were for not doing that. So that's a no-brainer. If you're getting a match, you always want to do that. But then after that, well, I also used to kind of be a little unsure on the answer for what's the best wrapper. Mutual fund, hedge fund, direct stocks versus ETF. And now I can say, I guess, I've got enough knowledge, like the ETF wrapper is the best wrapper for taxable money for almost all strategies. There are exceptions, but for almost all. So if you're using taxable money and you put it in an ETF wrapper, the ETF wrapper can kind of dodge a lot of the capital gains transactions that happen within the strategy versus you doing it yourself, trading stocks. Because what happens when you buy a stock, if you make money and then you want to go buy another stock, well, now you got to sell that, which is going to trigger taxes for you. Whereas in the ETF wrapper, when we sell a stock and go buy another, we don't trigger those capital gains distributions. So I think, again, it's a balance, but yeah, if you're getting a match, invest in that. If you're getting using your taxable money, most of the time go into the ETF wrapper.
Yeah, one of the cool things about the ETF wrapper is we've got a lot of strategies that would normally generate a lot of taxable changes that have sort of come out in the last few years that are now in ETF wrappers, and so you can follow those strategies in a taxable account, and as long as you're holding on to the ETF, you can basically defer all of those taxes, which is really cool.
Yeah, that's right. There's some other crazy stories in there too on the ETF wrapper, but I think we'll keep on topic. We could have another podcast on like my tinfoil hat theories that I think are more tinfoil. We've done some of it. I'm looking at fixed income mutual funds being the big tinfoil hat theory I have. So
we'll have to bring you back for the tinfoil hat episode. We haven't done one yet, so that'll be our first one.
Put it on.
So getting to your asset classes you invest in, you sent us a pie chart, which we'll put in the video. But I'm wondering if you could sort of talk at a high level about sort of what you're invested in and what that pie chart looks like in terms of your asset allocation.
So I just found it funny because in preparation for this, I was like, all right, I'll watch the episode you guys did with Wes. And yeah, it's a little bit funny to me, somebody had asked you guys to have me on, so cool. As you guys said, I'm younger, so I don't have the same amount of capital most of your guests before me had on. And but the interesting thing was Wes had in his pie chart, he said 76% of his wealth was Alpha Architect equity. And then I just, before this, for the first time, I was like, oh, I better make my own little pie chart here. So I spun it up and I was like, oh, it says 76% of my wealth is Alpha Architect equity. Now, my pie is just much smaller than Wes Gray's, but which I don't think I'm revealing any too hidden secrets there. But yeah, so Alpha Architect equity is the ownership I have in this company is the bulk of my wealth. That just happened by it growing. That I think that's just the name of the game when you own company stock. And then the other 24% then is I invest in momentum strategies. I invest in value strategies, and then for 50% of my portfolio, so long only equity, long only value and momentum, and then the other 50% of my investment is in trend followed equity. And we could go into the whys on that, but yeah, that's the pie.
So when you look at the liquid portion of your portfolio, do you make any changes to that because Alpha Architect is such a huge portion of your net worth? I mean, I don't think you, knowing what Alpha Architect believes in, I don't think you were buying unprofitable tech anyway. So you probably wouldn't stay away from, like the highest risk stuff. But I'm wondering, do you think at your young age that makes any difference that you have that much money in the ownership of one company? Do you change anything with the rest of your portfolio because of it?
Yeah, it did. That's why I said as of about 3 months ago, I was 100% trend followed equity. And that was the logic behind it. It's something Meb talks about too. Hey, if you're working for or own a long only equity manager, like you have enough beta exposure, right? You have enough market exposure. Market goes up and down is going to greatly affect things. So the trend followed equity was nice to kind of remove a bit of that for me. And working in finance, working in asset management, as you guys know well, like 20% drawdowns, you're like, whatever, right? Like that's, same song, different year. But if we have something like an 80% drawdown, well, now it's like, that's going to hurt things, right? In like your day-to-day life. I thought it was important to have some trend followed equity for the bulk of my investments for that reason.
Yeah, it's interesting. We were talking about this before the podcast, but it's something I think of too, is like this idea of, coupling trend following with sort of a buy the dip idea that, when trend following does protect you, if you put a little more money in the long only, because we know about trend following, it's going to take a little bit when the trend reverses for trend following to get back in. So like this idea of slowly buying the dip, I haven't been able to figure out how to do it quantitatively, but it's a really interesting concept. I think it makes a lot of sense.
That's right. Yeah. And so thank you. Because that was the next part, right? So I was 100% trend followed equity all of like 2 months ago or so. And I took 50% of that and just bought long only momentum and value strategies to basically try to, the trend followed equity had protected me. And then I was able to get in at the long only equity at a lower price. So that was cool. It was like, yeah. Now, again, to your point, like, is there a way to quantitatively do it? Like, there's no, I just do it ad hoc. I was like, oh, I can get in at a lower price now. Cool. I should have waited. Stock market kept going down, right? So like, there's no way to perfectly time the bottom. And I may, I definitely may sell even a little more to lock in some more long only equity. I don't think I would go lower than like 30% of my portfolio trend followed equity, but that other 20% I have in trend followed equity, I could see myself moving in the next couple months here.
And how do you think about incorporating value and momentum in your portfolio? You sort of talked about you've got equal weights between them. What do you think about like the idea of like, do you rebalance between them? Do you sort of just keep them equal and try to occasionally bring them back? How do you think about sort of the blend between the two of them?
I just basically keep them equal. That's one of the things that I just think falls into, it's just the least, so far down my list of concerns, right? If the number one thing I could do to increase my wealth is go make more money, then that should be my top focus, right? Like how do I add more value to the world that the world now will give me back a portion of that. So that's the most important thing. Then investments, as my investments grow, they do matter. But my timing on my rebalances is just like I'll just look at what long only stock strategy do I have less in. I'll just go buy that with new capital. So that's kind of the way that goes. There's no heavy thought into rebalancing at this point. And again, there's like the ad hoc thing of, well, hey, the trend follow protected. Let me buy some, buy the dip, right? But nothing too quantitative or serious thought power behind that at this point.
Yeah, and I like seeing that you're kind of a sleeve multi-factor investor, which is the way I like to do it too. You know, we had Daniel Crosby on Show Us Your Portfolio, and he actually, first of all, I was surprised he was a factor investor. I thought he'd be an index investor, and he's like an aggressive, very aggressive focused factor investor. But he's an integrated factor investor. He's kind of doing it the other way, trying to find like stocks that have simultaneous multi-factor portfolios. But I like the idea, like you're doing, of having value, having momentum, and kind of having them as separate sleeves within a portfolio.
Yeah, it simplifies things. It's It's a different yin and yang, right? Value is buying stocks that are cheap. Momentum is buying the stocks that are strong. Sometimes there's overlap in those two, such as right now, because what's cheap and strong is energy stocks. So it can be interesting that when there's overlap. But yeah, most of the time they're kind of very different things. Is there
ever a chance, would you ever reduce your equity exposure? So, Meb Faber had this thought thing he did on Twitter where he was like, what if the CAPE went to 50? What if the CAPE went to 100? Given that you're younger, I mean, is there any situation where the valuation of the market would lead you to reduce your equity exposure?
I don't think so, but right now, my investment portfolio is probably like the most simple it's ever been. And that just goes back to like what stage you're in and what amount of risk you can afford to take. And like my risk has been lowered in the last few years for the risk I could take. And also like that Alpha Architect equity piece becoming such a big part of my wealth, like also changes like how you think about things. I mean, you said, hey, Ryan, you're probably not buying like those expensive stocks. Well, like I did. So like, kind of sacrilegious. I bought Tesla stock, like way back in the day. And I remember I bought it when I was at the New York Stock Exchange, and I bought it when it was like $12 a share or something. And I remember the price it went up to $36 a share. And everybody at the New York Stock Exchange was like, dude, you got to sell. Like you just tripled your money. Like that's unbelievable. Like get out. It was like I turned $1,000 into $4,000. And like at the time I was like, oh my God, I turned $1,000. Like, oh my God. And I kind of didn't sell. And I mean, I actually, making a longer story short, but I kind of kept buying Tesla. And I used that to buy, and because I didn't have this in my wealth pie, but I did pretty well on Tesla stock. I used that to buy a rental property. Like I sold Tesla when it was like, for its stock price today, and it's because it's been split like 20 times or something. I sold it when it was like at like $120 a share or $130 a share. Like I think today it's like $180 a share, 170, something like that. So I mean, like, and I put a good amount of my wealth into that and just kind of rode it. And it's really hard because I'll sit back and think about it a lot. I'm like, was that just dumb luck, or did I really know? Like, did I have some edge there? Because I convinced myself that I knew that I had some edge, and it worked out. But it's impossible for me to know like whether that was skill or just dumb luck. But so that did get me a quasi rental property. I use it like it's in a beach town, so I both use it personal and rent it out. So yeah, like that was kind of a weird one, but like I wouldn't have taken that risk now, right? So that's where it's just this constantly evolving game where like what are the given tools you have, and then that dictates, because like I'm always looking for opportunities. Like if there's something I'm like, man, this is sure can't miss, like I feel really good about, could I take some money and get a little more exotic? Like, yeah, I would be willing to do that.
One point I wanted to make with your liquid portfolio is you know exactly what you're paying. And I think a lot of investors out there have no idea what they're paying in these funds or their advisor account. And I mean, given your expertise in, ETFs, and given that most ETFs come with, lower fees than mutual funds, that's an important thing for investors to just understand, I think, and think about. And your portfolio is very simple. You have your whatever 3 or 4 ETFs, and then you know what the fees are. Call it a day.
Yeah, and like again, as I get older, versus trying to trade single stocks and stuff, the systematic, like what I'm doing, I believe, is going to add outperformance over the long term. So that kind of scratches that itch of like, well, I want to outperform, but also I kind of want these systematic things because I don't have the free time I did to be like studying stocks and analyzing. So I'm like happy to outsource, into systematic investment strategies, time that I used to spend. Because that was also a joke I had too at certain points in my life. I was like, man, I get stock market like returns with a ton of volatility. Like, yeah. So I think I got some questions. You have some further down questions I could get into that on. But
one of the things I noticed was missing from your portfolio is bonds. Is that a function of the fact that you have a really long time horizon? Is that a function of the fact that yields were really low, at least coming into this year, and so bonds didn't make a lot of sense? Like, what's your thought process in not having bonds?
Yeah, they never made sense to me. I never owned bonds. And like when I'm, 22, 25, 30 years old, and these things are yielding because, I started investing basically at the exact stock market bottom, like June 2009, so just a little after that. But yeah, like it was like, oh, this thing's yielding 4%. Like, well, that stinks. Hey, look at these stocks. They can get me 10, 15% a year. Again, that was my young mind. But even still, as I got more knowledgeable, it was just that. I would much rather have cash and capital on the sidelines. And when you're building your career too, like as we said, there is this thing. I have this this human capital where I got a paycheck every 2 weeks or every month or whatever for most of my career, so it's like, well, I know I got more cash coming next week, right? Because I set my life up where my fixed costs are much lower than my my income. So like I got more cash on the way, right? So if there is like, oh, well, you should always have X% in bonds or whatever. Well, my income acted like my bond portfolio where I was able to buy the dips and do those things, and like reduce my volatility, I guess, in some sense, via income. And obviously you could pick at that and say, oh, well, what happens if you lost your job or whatever? That's true. But then I always looked at that too. I'm like, yeah, but if I lost my job, I still have that investment portfolio. And again, even if it was at the worst time where it's down 50%, well, I was young and I had such a low cost of living that I was locked into, like, if I needed to blow things up, and like get my cost of living to zero, like when I was younger, I could do that real fast, right? Like, so yeah, you could just take risks. You just don't need bonds.
Yeah, that's a really interesting way to look at it, sort of as the income is a replacement for bonds. As you grow older, I mean, do you think you'll add bonds? I mean, do you think that's really a long way in the future? Or is that something, with yields up now, you might think about like in the next 5-10 years, something like that?
Yeah, it changes perspective for sure. I kind of like the idea of trend following bonds. At this point, like I could see myself doing that in the future. Because what happens, we were in a 30-year bull bond market, and this is all the education journey I'm on for finance, right? Where like people like Wes and Jack are ahead of me there, and other people I learned from in the industry, like Meb, you said, it's if we were in a 30-year bull bond market where bonds were just going up, and that was incredible. But what if we're in a 30-year bear bond market and these bonds are just going to become less and less valuable every year, essentially, maybe not in a direct straight line down, but so yeah, I don't know. At this point, I really like the idea of like cash, and then maybe in the future, not now, but maybe trend following bonds for myself. Personal finance is personal, right? It's different for everybody. And then, but I just want to acquire as many assets as I can. Like at this point, that's my focus.
Yeah, in bonds, I've kind of come around to the way Wes looks at it. Like when Wes was on the podcast, he said it in like the way only Wes can. But he's like, why would anybody ever own bonds without trend following? He's like, it makes absolutely zero sense. And I think that he's right about that. So I think it probably does make sense, if you incorporate bonds to use trend following, because it does have bonds do have these long trends they can get into.
Yeah. And I am, I'm, working with Wes every day. So I drink the Kool-Aid. He's implanted himself in my brain pretty good from an investment perspective. So
just one more question on the equity piece. How do you think about international exposure? There's some people who think, you get everything you want here in the US. You really don't need to own international stocks. And obviously, at least if you think about shorter time frames, that's worked out very well. The US has outperformed international stocks for a long time. But then there's other people who think about, that international exposure really is over the long term, something that's going to enhance your returns or give you more diversification. So do you invest in international stocks, and how do you think about that?
Yep. So I just do value and momentum investing internationally. And like how I think about that is on emerging markets, I don't do emerging markets. The data, if you look at it, just for emerging markets seems to give you the same returns as international developed equities, but with just a whole lot more volatility. So that just kind of is like, And then there's also this thing where you look at like back tested returns on things like, let's just pick on emerging market equities. There's a difference into like forward expected returns. Like you really got to think intuitively as to why something should give you like a premium. And we're all learning that lesson really, really hard right now in China and Russia, right? Like Russian stock market went to $0. Russian stock market was like the darling of emerging market investors forever. It was like the entire Russian stock market trades at a PE of 2. Like, what a steal. Like, so you could put this amazing story on Russia, and then like all your capital's gone, like just gone. So, and like we're on a maybe similar path with China. Like, I don't know if your money's going to go to 0, but I know Perth Tolles shared it a bunch, and I don't know who created it, but somebody just showed the Chinese stock market returns of the last 40 years, and it's basically 0. Like even with that huge run up, like your actual returns were 0, because in these communist dictator countries, they don't care about you receiving money. And I have actually some coworkers here who lost millions of dollars. Previous coworkers lost millions of dollars. They had a Chinese company, and just one day the Chinese government just said, nope, that's ours. Like, that's ours, right? So that happens. Like China does that. You can't really do that in America. You can't really do that in these countries that have property rights. So yeah, like whether you should invest in emerging markets at all is tricky. I think there's like, if you're a financial advisor, I build models with financial advisors a lot, and I'll include like a 5% sleeve to emerging markets. I say this openly to them. Like the reason we have that in there is just potentially behavioral. Like if we go back through a 2000 to 2005 scenario where emerging markets just go up 300%, you just kind of want to have something to that, just so your clients are like, I think like behavioral can drive a lot of answers, because the best thing people need to do is be able to stick to what they're doing, right? So on international, I do international developed. I don't do emerging markets. There's also these huge trading costs and taxes when it comes to emerging markets that you can't get around. So so maybe a little too much info, longer answer. I don't know, but yeah, these are all just like such deep questions that like each one of these questions we could spend 5 hours talking about probably, and even that, like we wouldn't have the answer, right? Like we would all just be like, yeah, okay, well, let's think about it again tomorrow.
Before we just move on, I do want to, speaking of the behavioral sort of sticking with it, some people might listen to this and say, oh, like trend following, that sounds like a really good, interesting strategy. But, I'm wondering if you could just talk about sort of just the realities of trend following. There's good parts of it, there's bad parts of it. The important thing is that investors stick with it. But, from your knowledge and experience, like what would be the pluses and minuses that investors should know going in with their eyes wide open?
I think I don't know if it's Nassim Taleb's quote or if he just says it, but I know he says it. There's like a quote: "If I gave you tomorrow's newspaper, you would lose all your money." Right? Like, and I butchered the quote a little bit, but that was the general gist. Like, I could give you all of the details in the future, and you would lose all your money. like I could say, okay, Justin, Jack, there's going to be a worldwide pandemic. The entire U.S. economy and world economy is going to shut down on March, whatever it was, 10th. Like, what do you guys want to do with your money for the next year? You'd be like, I'm going short everything I have. And you would have lost all your money. Because somehow, some way, yeah, the stock market went down 20%, whoop-de-doo, and then figured out a way to go up like goddamn 60%, right? So like if you went all the way short, you would have lost all your money. So trend following, like I'll give you another similar story on that. Let me see how to frame this properly. So trend following is interesting because you basically get whatever asset class you're investing in. Historically, you get the returns of that asset class with significantly reduced drawdowns, often around, give or take, like 50% less drawdowns. So than just simply buy and hold. So that's interesting. You're like, oh wow, same returns, lower drawdown. Sign me up. Well, okay, so now let's just like zoom in on just one asset class we could trend follow, the U.S. stock market, right? So let's go back in the last, 2022. We'll go back, to 1927. Let's say like last 100 years. I'll give you the max drawdown number of the U.S. stock market is about 83%, and I'll give you the max trend followed drawdown of the U.S. stock market. It was about 42%. When do you think those two time periods were? Like this is a quiz for you guys now. You're on the spot. When was the max trend followed, and when was the max buy and hold drawdown of the U.S. stock market?
So I'm going to say, I'll go first. I'll say, and maybe I know the max drawdown long only would have been the Great Depression. So it would have been either 30 or 32 or something, or 29, something in there. And I bet the max trend following would be during some bull market where it was a great run for stocks, but there was just a lot of volatility. And so the trend following never was able to really get it right. And it kept on getting whipsawed. So I don't know when. It might have been like the 90s or something. I don't know. That's my guess. Jack, what do you say?
Yeah, I mean, I was thinking definitely the Great Depression is the first one. And I was thinking maybe the 70s in the second one, but I'm not really sure.
Yeah, so I did my best to stay reactionless there because I didn't want to give Jack any help on Justin's answer, any clues. So that was hard. So if I looked weird on camera, that's why. So yes, exactly. Everybody knows the max drawdown, 83% Great Depression. Everybody knows that one. The worst trend followed drawdown came in the 40s. So the stock market was down about 44%, and a trend followed on the S&P 500. A trend followed S&P 500 strategy would have been down like 42%. Like would have saved you 2%. And just imagine that in today's world. Like if the three of us are if we were doing trend followed on the S&P 500 and we had a little bit of capital invested in the Great Depression, we would have been geniuses. Everybody in the world would have given us their money because in the Great Depression, trend followed, you only went down 20%. So it saved you a 60% additional drawdown. So we would have been the richest men in the world. Everybody would have given us their money. Been these guys are wizards, absolute wizards. They got out. And then when it finally turned around, they got us back in. But then the next big drawdown, we would have gone down the same amount and everybody would have been screaming at us that we are morons and we don't know anything, and capital would have left and should have invested in, whatever else. So it's just amazing. Trend follow still works, but that's the downside. It just doesn't work at all times. And we've seen that in recent history with live trend followed strategies too. Some of the drawdowns, they kind of take you down with the drawdown, just, because you're just kind of getting whipsawed. And then, on other drawdowns, they've really saved your tail. Like this current drawdown has been excellent for trend following. So that's a trade-off. So you gotta understand it, because that's what's going to keep you able to be invested with it.
Just one more thing I wanted to ask about your portfolio before I hand it back to Justin. Since you are the youngest guy we've had on here, I wanted to ask you about crypto. Did you do any investing in crypto? Did you get your Lambo? Did you invest in any of the coins, or how did you sort of think through that whole process?
I did for 2 weeks. But working at an asset manager, you have to file every trade you make. And I was like, this was not something I wanted to buy and hold. I just viewed it as I was like, wow, this is a good thing to trend follow on. So I owned it for a little bit. Again, I turned $1,000 into $4,000, but I was having to spend half my day filing trades and stuff with compliance at our firm and getting clearance, because we have to get any trade we make, we have to get clearance. And then, so I was and that's obviously now I'm driving somebody else at our firm nuts, because every day, you had to have a super tight trend follow on there. You can't do like we do for equity, a 1 year trend follow signal. It's I was trend following really short time frames. So it kind of worked, but I only did it for 2 weeks, but it was a lot of fun. It was the first big run that, on a national level, whatever it was December 2018 or something like that. I remember we were driving up to New York City for work for something, and I was watching Bitcoin go up $1,000 every 20 minutes. It was $16,000, $17,000, $18,000. It was oh my God. But that was it. I just otherwise, 1, too time consuming again to do that type of trend following on it. 2, in the too hard bucket. Buying crypto is just, it's no different than buying an individual stock. I don't know what the answer is for 99.9% of individual stocks, whether they're going to be good or bad investments. And actually 80% of individual stocks underperform cash over the long term, right? So if you're just randomly picking stocks out of a hat, you're actually much more likely than not to underperform cash. So it's obviously, if all of crypto is basically the equivalent of investing in a single stock, it's the same thing. You're trying to figure out, is this going to work for the long term or not, and everything that goes with it. For me, too hard bucket.
One of the unique things, I'm looking back at the pie chart. Sorry, we haven't kind of moved off this, but it is, and I'm sort of like you, Ryan. I think if I believe in something and I run strategies, I pretty much am invested in them, and sort of right alongside our clients. And I mean that's pretty much what you're doing. But what's interesting is listen, Meb and Wes, they're different with their sort of where they are in their career and stuff, but your wealth, at least with this portion, because like you said, you have the rental and you have your house and stuff, which I do want to talk about just in a second, but your overall portfolio is very tied to the success of the firm and the success of the strategies. So it's very tightly correlated to these strategies working, because as the strategies work and the ETFs grow, the firm becomes more valuable. So someone might look at this and say, that's almost too concentrated on the success of Alpha Architect, and you might benefit from something completely uncorrelated, like Wes with the managed futures stuff. He had, whatever it was, 100 managed futures contracts that somebody on Twitter, was it Rick Ferry, that's good luck, if something happens to you, Wes, that your wife understands all this stuff. But I don't know, it's interesting, but I kind of identify with that style, that you're working at Alpha Architect, much of your wealth in the future is going to come from the success of the company, and you're decked up right up alongside your clients, invested in those funds. It's just a financial advisor might look at this and say, man, you got to get more diversified. You got to get something uncorrelated to Alpha Architect. I don't know what you think about that.
No, I think it's a great question. I mean, the one thing to remember is we're not iShares, and this is no shot on iShares. I think they're very open about it. What is iShares' mission in the ETF world is to launch an ETF on every single asset class with every single strategy available, like to give you investors access to every asset class in the world and every single strategy on that asset class in the world. Like that's basically iShares mission, and true for a few of the other big shops too, right? And at Alpha Architect, we are different in that we say, no, we're actually saying this is, we believe, the best strategy if you're trying to invest in this asset class, right? So so that matters, right? Because I'm putting this in because we're sitting here and we're like, we believe this is the best way to invest your money in these types of strategies. I'm not saying it is the best. You could debate it, but yeah, it's the best way to invest your money in this strategy. So that's why I do that, because it just makes sense. I don't know of a better way to do it. And then two, yeah, it's correlated with Alpha Architect, but we get that question a lot too. Hey, what happens if Alpha Architect disappears tomorrow? Like, me, Wes, and Jack are all on a plane and goes down, and I don't know, all of our investors sell and we can't cover the bills. Like, well, like whatever is left in Alpha Architect, like if Alpha Architect shut down tomorrow, just the way the ETFs are, they're actually separate companies than us. So we could shut down tomorrow and Alpha Architect ETFs would still be operating, essentially. Like now you'd have to find somebody to operate them, but that's the job of the board that oversees each ETF. So it's all good. If something should happen, the strategies would live on.
So just before we kind of wrap up here, I do want to get your thoughts on, so you have the rental property. You bought that with the Tesla stock. You own a house that you live in, and then is there any other? But you didn't include those in the pie chart. Is that because you kind of just don't think of those as part of your net worth, or do you?
Yeah, I mean you do, but I just consider them like they're just. I mean, well, one, your personal home, no, I don't consider that at all. I consider that purely consumption, right? Because that's only not consumption for your kids. Like when you pass away, your kids, I guess if you have equity left in the house, they will get that whatever that is, right? I don't need something like a reverse mortgage or something, right? So your personal house, no, I don't view that as anything of my net worth. It's purely consumption. Yeah, the beach house, rental property, quasi deal. Yeah, it's somewhere in the middle, but it's the same thing. I don't really worry about it or track it as part of my net worth. You can't help but be like, oh, what's it worth, right? But yeah, nothing there. I just look at it. My dad had taught me this, and he heard somebody else say it, and I just thought it was a really valid thing. My parents had a beach house. It's like the only house they own, but they would, we all meet up there like every summer, and our whole summer growing up, like high school, college, post-college, right? We would always return there. And so like, it's not necessarily a money maker. I'm not making money on it, but I can kind of finagle a way to make it a little bit break even. And then in the future, the great thing about having some vacation home, and you go all across the country, there's every city I go to, there's all some area that's like the getaway area. Those are places that your family will return to again and again and again. I kid around with my wife. We live in this town called Haverford, PA. Like we could own, there are like massive estates in our town. Right? Like we live in, I think, the smallest house in the town, which I make the joke. I say, oh, they say it's, buy the crappiest house in the best, on the best, like on a good block or whatever. And I'm like, oh, we bought the smallest house, in the whole town. Like, good job. We must be doing good. But like that point is, we could own one of these estates down the road. Like nobody would ever visit us in Haverford. Like people just don't care what's Haverford, right? But you own like a beach house, people will come sleep on our floor. They'll be like, hey, is the floor open this weekend, right? So like for me with my parents, like it always brought me home, and now that I'm starting a family and stuff, it's just a way. Like vacation homes bring your family together, bring your family back. So if you can finagle a way, I think you said it yourself. you have, in a note you sent me, you said you have a sailboat, which is a terrible investment, but you get joy from it. Yeah, like kind of similar idea. It's like may or may not turn out to be a good investment, but that's like a far secondary consideration for me.
Yeah, I think that's awesome. I mean, I think the fact that you did that as a kid, those memories were made with your family and your friends, and now you've kind of said, you want to do the same thing for your family and your friends, especially now that you have a child. I think that that's awesome, because as the kids get older, it becomes sometimes harder and harder to get them wanting to do stuff. But a beach house, the ocean, I mean, how can you not?
Yeah, I'm lucky. I mean, my kid's 6 months old, but I just look at him every day. I'm like, you will always love me. You will always love me. You'll never leave me. Like, just try to get that subconscious going.
The other great investment along those lines, which is also a terrible financial investment, is a swimming pool. Like, you kind of mentioned, like, nobody wants to come to my house. Like, that was kind of the situation for us too. And then we put a swimming pool in, and now it's like everybody wants to come to your house. So like,
everybody wants to come to your house.
It's a horrible investment. It doesn't really increase the value of your house that much. But like, I mean, if you want to hang out with your friends and family all the time, like, people will come to your house all the time if you have a swimming pool.
Yep, exact same thing. Yeah, my wife's aunt has a swimming pool, and we're at her house all the time. So yeah, it's exactly right.
So, Ryan, we have a standard closing question we like to ask all of our guests that do this with us. And by the way, this has been great. Thank you for opening up and sharing these details with us about your portfolio. But the question is, if you had to impart one lesson that you've learned from building your personal portfolio to your average investor, what would that be?
Just focus on providing more value in your life than you take, because then the rest just takes care of itself eventually. It's not always a straight line, like you give and then you get, then you give, then you get. But I think, if you just focus on providing people more value than you're taking, I think stuff will work out.
Thank you, Ryan. This has been great. If people want to learn more about you and Alpha Architect, where can they go? The banner in the back gives it away.
Yeah, this could be a dead giveaway. Just put a little .com right there. alphaarchitect.com. Come check us out.
All right, Ryan, thank you very much.
Thank you.
Yeah. All right, guys. Thanks for having me.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbono. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.